Welcome to the Capital News. I am your host, Alex Corritis. Today is February 28th, 2019. Thanks so much for joining me. Already the end of February, and spring is just around the corner. What does that mean for the economy? Well, we'll see what the headlines are, because that's really all that moves these markets, isn't it anymore? Just the headlines. Nothing fundamental until it isn't the case. That's always what I like to say. It's true until it isn't. So I am here to keep you posted. Let's get right into the markets. The S&P was down 8 points today. The Dow was down 69. The Nasdaq down 22. And the Russell 2000, the small cap index, was down 5.5 points. Oil, gold, and silver markets were relatively tame. And the 10-year bond now sits at 2.71%. So it continues to increase, which of course means there has been some further selling in the bond market. And the dollar remains mixed against its basket of currencies. Now, some of the news that came out today, of course, what day would it be if we didn't have some U.S.-China trade talk stuff? And this time it was in the form of one Larry Kudlow, the president's chief economic advisor. Well, what did he have to say today in regards to the trade negotiations with China? Well, we have made fantastic progress. Those were the words, fantastic progress last week when China was here with their trade delegation. He followed that up with, we are going to make a remarkable, historic deal. A remarkable, historic deal. So we got a lot of adjectives here, a lot of positive stuff. Oh, you almost think it's President Trump. It's fantastic, it's remarkable, and it's going to be historic. I mean, talk about overselling. I mean, if this thing isn't remarkable, if it's not fantastic, and if it's not historic, what's going to happen? And those are from their perspectives. Maybe they think it's historic. I don't know. Well, the markets think it's historic. That's really what matters, because if they think it's historic, well, then we might make all-time highs. If they think it's a dud, we might retest lows, because there's not much holding up this market except headlines and some fancy, smancy money printing from central bankers the world over. Some other news that came out today, and I'm going to read a couple articles to you in regards to that. We finally got the fourth quarter of 2018 GDP numbers. And what happened with the markets? Oh, yeah, that's right. They were all down today. So despite the fact that GDP beat estimates, the market still went down. Now, there's a whole slew of information and geopolitical risks taking place, so I don't know if that's starting to get baked into the cake. I don't know if this is simply, again, we are hitting technical levels on these markets that have proven to be tough resistance in the past. So there's a whole bunch of things going on right now, but as far as there being a strong catalyst to move us up to new highs and to break through this resistance convincingly enough to convince me and a lot of other people that this is going to be another run to new highs, it is going to have to be a fantastic, remarkable, and historic deal of proportions nobody could have dreamed possible, because the summit in Hanoi, Vietnam turned out, unfortunately, to be a dud. Not that it was a move backwards, but it was definitely not more progress. So that was a dud. Thank God there seems to be a de-escalation of force in India and Pakistan. So that sort of is simmering down. You still have the Brexit concerns. We still don't know what's going to happen there. And within a couple weeks, we're going to see some more sunshine as to what is more likely to happen, whether there's going to be a deal, no deal taken off the table, or if there's going to be an extension. We also still don't have any further inclination as to what type of extension we are going to see with the tariffs on Chinese imports. How long is that going to be? Because we're also told that President Trump and President Xi may very well meet within a few weeks' time at Mar-a-Lago. So a lot remains to be seen. This is headline-driven, but let's get to some of this data. So allow me to read you the report. I'm not going to read it in its entirety. I don't want to bore you to death, but I do want to touch on the main points from the BEA, which is the Bureau of Economic Analysis, which is a wing of the Commerce Department. So gross domestic product, fourth quarter and annual 2018, the initial estimate. Real gross domestic product GDP increased at an annual rate of 2.6% in the fourth quarter of 2018, according to the initial estimate released by the Bureau of Economic Analysis. In the third quarter, real GDP increased by 3.4%. Due to the recent partial government shutdown, this initial report for the fourth quarter and annual GDP for 2018 replaces the release of the, quote, advance estimate originally scheduled for January 30th and the, quote, second estimate originally scheduled for February 28th. The Bureau emphasized that the fourth quarter initial estimate released today is based on source data that are incomplete or subject to further revision by the source agency. Updated estimates for the fourth quarter based on more complete data will be released on March 28th. So we have to wait an entire month to get the revised version of these GDP numbers. What will happen? Will they go up, go down? Your guess is as good as mine. You know, we're all weathermen when it comes to this stuff. I don't care what model you have. If you hit it on the head, you got lucky. Okay, so I'm just going to be honest with you on that because these numbers can come out of nowhere. I'm going to continue. The increase in real GDP in the fourth quarter reflected positive contributions from personal consumption expenditures, PCE, non-residential fixed investments, exports, private inventory investment, and federal government spending. Those were partly offset by negative contributions from residential fixed investment and state and local spending. Imports, which are a subtraction in the calculation of GDP, increased. The deceleration in real GDP growth in the fourth quarter reflected decelerations in private inventory investment, PCE, and federal government spending, and a downturn in state and local government spending. These movements were partly offset by an upturn in exports and an acceleration in non-residential fixed investments. Imports increased less in the fourth quarter than in the third quarter. So I'm just going to take a quick pause here and then finish up on this article just to go over a couple items on this list so far. So when we're talking about a positive increase in private inventory investment, you have to look at this in the right context. This has to deal with businesses increasing their inventory. So a lot of this has to do with purchasing managers, which obviously translates to the PMI that I talk about on this podcast because that's an important data point to look to see if the economy is expanding or contracting. And right now, at least as far as the manufacturing PMI is concerned, we are in a downtrend, but we are still above that 50 threshold, which would suggest that we are still in an expansionary mood, which is still good. But we are in the downtrend of that. So, again, that's my job to keep you guys posted, and I will definitely do that. But the point I want to make in regards to previous and this GDP number has to deal with the fact that because we have tariffs, this is an artificial increase in the price. It's a tax. That's what a tariff is. It's a tax on imports. So you have these companies that have to make business decisions. They have to do forecasting. How much are my sales going to increase? How much are they going to decrease? How much do I have to buy? If I buy more in bulk, do I get a better price? What's going on? And then they're sitting there with uncertainty because they don't know what this historic, remarkable, fantastic deal is going to bring them. But we are told that previously, because these tariffs have been on for nearly a year, that we have 10% on a certain amount of goods. We might increase them another 10%, might increase them to 25% on a certain number of goods. Okay, so there's uncertainty. So when there's uncertainty, businesses pause, they freeze. They say, well, I don't know what's going to happen, so how can I make really an educated business decision on this uncertain information? Well, if they think that it's more likely that these prices are going to increase, that there's going to be additional tariffs or anything of the like, if they can, they're going to buy more goods. They're going to build their inventories. Okay, this is highly logical and is predictable. It's rather predictable because they don't want to eat all of these costs of the higher price, because if they can get these things at the cheaper price and then sell them at the higher price, they can pocket the difference, or they can at least remain competitive in their markets, because there's a couple of things that these companies can do. They can buy a whole bunch of items in preparation of these tariffs, and then that allows them to either pass on the entire cost to the consumer, or if they want to be nice to the consumer or attempt to remain more competitive in the market, they can eat some of that cost increase. But that's going to come at the expense of their margins, of their profitability. So they have to make that business decision. They didn't have to make this business decision in the absence of the tariffs. So you have to understand how everything is connected. This is the business cycle. This is business in action. This is the intersection of politics, geopolitics, economics, and business. These are predictable outcomes. It made sense that these inventories were built over the third and fourth quarters, really the second, third, and fourth quarters. But what's going to happen as we start to see retail sales starting to decline? But now you also have that coupled with built-up inventories. So what's going to happen to prices? Well, if you have an overstocking of inventory and you don't have a lot of people there to buy it, well, you're going to have a lot of markdowns, aren't you? So what's that going to mean as we move forward into the first and second quarter of this year? Is that going to start to sneak into the numbers? Because all of this is very much akin to debt. As I always tell you, debt is simply bringing future progress forward, future spending today. That's all it is. This is the same thing, just on the other side. This is business spending in anticipation of tariffs, of a tax coming on that's going to increase the cost of these goods. So they want to remain competitive. They have to make a decision. And a lot of these guys made the same decision. And they said, we're going to build our inventories. And that's exactly what they did. And because that's how that is a number that contributes to GDP, well, it was additive. So it's no surprise that GDP went up. So in the absence of these tariffs, ironically, you wouldn't have had GDP at these numbers. Now, the other thing I want to point out in all of this is, for those of you who may not be aware of how GDP is calculated, it's, for all intents and purposes, it's a simple arithmetic equation. It consists of government spending, it consists of investment, it consists of consumption, and it consists of net exports, which is comprised of exports minus imports. And because imports are typically higher in this country, that turns out to be a negative number, which is what the report stated. Imports, which are a subtraction in the calculation of GDP. That's what the BEA said in their statement, which is obviously very true. So the other thing that this report notes was government spending. Now, there may have been a slowdown in the fourth quarter. That may have been obviously because of the partial government shutdown. But throughout the year, we know that the deficits are skyrocketing. Now, what we're told the deficit is officially is that it's about 800 to 900 billion. But that's not true, because you have to look at other numbers. I mean, if the federal government, or probably the state, local governments, if they had to report the way that corporations and you and I have to do, they would be in jail. But that's not, they make the rules, so they get to bend them and break them anytime they want. If you look at the real deficit, which you have to look at the change in the net change of national debt, you're talking closer to $1.2 trillion. Okay, that's an astronomical number, and that's a huge number in the context of this supposedly best economy ever. You don't have trillion-dollar deficits in great economies. So that spending contributes to GDP, because government spending is a huge part, and it shouldn't be, but it is. It's a huge part of GDP. So if you remove that number, where do you think I'm going with this? You're not talking about 2.6%. You're probably talking about a number that is sub 2%. So, the president and the Republicans and talking heads who support him, that's fine. You want to support him? Great. There's a lot of things I agree with the president on, but I'm not going to sit here and be a lapdog to him, believe you me, because we deserve the truth. That's what this program is about. If he wants to go and do deficit spending to get GDP up to 2.6%, okay, how much longer are you going to keep it up? Because all you're doing is contributing to the national debt, which needs to be paid at some time. And if you are in an environment with increasing interest rates, the amount just to service that debt, the net interest payments alone, are going to be devastating. So when are we going to get off of this gravy train? I mean, are we going to be adults and tackle it head on? So far, we have not. I mean, you look back to President Bush, he blew through it. He didn't care. You look at President Obama, he had the opportunity of a lifetime to be one of the greatest presidents ever. And I say that I did not vote for him. I did not care for him. But he was in a situation when he came into office to truly become one of the best presidents ever. And he blew it. He will go down as one of the worst because he didn't know what the hell he was doing, or he was handled by people who didn't know what the hell they were doing, or they knew what they were doing and they put us in this mess on purpose. So there's your choices. He was either incompetent beyond belief, or he did what he did intentionally. And there's double the national debt, Obamacare, escalation of wars. I mean, just go down the list, right? Now you have President Trump, who was supposed to come in and drain the swamp. Well, so far, maybe on some things, but on others, definitely not. Definitely not. And this is one of them. And this is something that is only getting bigger with time. And he basically dismissed it when I said to you guys in a previous show, when he was asked about the national debt finally, because he didn't bring it up in his State of the Union address, but some reporter finally had the cojones to ask him about it, and he said, oh, we'll just grow out of it, which is completely dismissive, completely irresponsible, and the reporter should have pressed him on it. If you're going to ask a question on these things, have a little more sense about the mathematics behind it, because if you want to pay off this debt, if you want to use growth, it's going to take decades. Decades using astronomical growth assumptions, which just ain't going to happen. All right, so you got to call bull when you see it and hear it, and that was a bunch of bull, okay? We are not anywhere near the type of growth rate that we need to be to cut into this debt to the degree where it's really going to help this country's financial balance sheet and get this country growing to where it can, because there is a ton of potential here. Don't get me wrong. There's a ton of potential in this country that remains and exists, and I believe will persist. But if we continue down this road of being on the gravy train, $1 trillion after $1 trillion deficits in a time of supposed great economic growth, come on. Just, don't just believe these people because you agree with them and you voted for them. Hold their feet to the fire. Don't hold them on a pedestal. This is your life. This is your money. Okay? So take it seriously, because we don't take it seriously, and that's why this stuff runs out of control, and that's why we're treated like children. And we don't need to worry about that. You want this? Yeah, we'll tell you that exists, and we'll give it to you. We're not going to be able to pay for it, but we're going to give it to you, and we're just going to appease you. And then sooner or later, it's going to go boom. And I think that's going to happen sooner rather than later. Let me continue with some of this report. Lastly, 2018 GDP. There's a whole bunch of other stuff you can get into if you really want to dig into it. Real GDP increased 2.9% in 2018 from the 2017 annual level to the 2018 annual level, compared with an increase of 2.2% in 2017. So there's year-over-year growth. The increase in real GDP in 2018 primarily reflected positive contributions from PCE, non-residential fixed investment, exports, federal government spending, private inventory investment, and state and local government spending that were slightly offset by a small negative contribution from residential fixed investment. Imports, which are a subtraction in the calculation of GDP, increased. Now, real quickly, that's another thing I want to talk about, because President Trump, wants to tout himself as this great wheeler and dealer and how important trade is to him and his administration. Well, if you look at the data, our trade deficits are just getting bigger and bigger. I don't know if this is part of the grand historic plan that is in the making. I don't know if, you're cleaning a room, it has to get dirtier before it gets cleaner. If that's the scenario, the argument they want to make, I mean, maybe we can buy that for a little bit, but it's definitely not getting smaller. Our exports are definitely not overcompensating the growth in imports. So unless and until that happens, this is going to continue to be a drain on our GDP calculation for the foreseeable future. But we'll see what type of deal there is. Maybe it will be fantastic, remarkable, and historic. Let me continue. The acceleration in real GDP from 2017 to 2018 primarily reflected accelerations in non-residential fixed investment, private inventory investment, federal government spending, exports, and PCE, and an upturn in state and local government spending that were partly offset by a downturn in residential investment. Okay, interesting. Lastly, current dollar GDP, and I'll explain the difference if you're not aware of this. Current dollar GDP increased 5.2%, or $1.02 trillion, in 2018 to a level of $20.5 trillion, compared with an increase of 4.2 or $778.2 billion in 2017. So there was a nice gain year over year in current dollars. Current dollars does not, that would also refer to nominal, depending on the articles you might read or the business news that you're paying attention to. They might say current dollar GDP or they might say nominal. In order to get to the real GDP number, what you simply do is you subtract the inflation number from current dollar or nominal GDP. Subtract that, take inflation, subtract it, and then you have the real GDP. So it's just a simple calculation, okay? Allow me to continue. The price index for gross domestic purchases increased 2.2% in 2018 compared with an increase of 1.9% in 2017. During 2018, measured from the fourth quarter of 2018 to the fourth quarter of 2017, real GDP increased 3.1% compared with an increase of 2.5% during 2017. The price index of gross domestic purchases increased 2.1% during 2018 compared with an increase of 1.9% during 2017. So inflation is now at 2.1% according to this report. Okay, so if you look at this report and you want to do the math, or you want to do the math in your head, it's very simple. If you have the 5.2% in current dollar GDP, you subtract the inflation, so 5.2 minus 2.1 gives us real GDP increased by 3.1%. So there's your math right there in the article. Nothing to become intimidated by if you're reading a business article or listening to talking heads on Bloomberg, CNBC, Fox Business, any of the like. You're in the know. That's all it is. It's simple math. So don't get intimidated by that. Lastly, before I go, I want to read another article because I find this stuff fascinating. Greenspan warns U.S. budget deficit will ultimately lead to higher inflation. The yawning federal budget deficit is ultimately going to eventually lead to a higher inflation, former Federal Reserve Chairman Alan Greenspan said on Thursday. The federal debt to gross domestic product ratio is on track to be as large as it was during World War II, Greenspan said during a talk at a National Association for Business Economics conference. Unless you believe in fairies, that is not an economy that can function without inflationary instability, he said. The former Fed chairman despaired the lack of political pressure to control entitlement spending and narrow the deficit. Despite the huge increase that we've seen in the debt, nothing is happening. People are behaving like it's a terrible thing, but say, I want a little more. Current Fed Chairman Jerome Powell and his colleagues have said that they see muted inflationary pressures in the economic horizon. That is a key reason the Fed has said it can be patient with further interest rate adjustments. Greenspan was fairly upbeat about the fourth quarter GDP data released earlier Thursday, which showed a 2.6 growth rate above economists' forecast, which we just discussed. He continues, the long-term outlook is terrible. Well, that's good news. The short-term outlook is not too bad. So there we go. We have terrible, and the short-term is not too bad. You know, it amazes me how these guys come out after they're no longer the Fed chairman or involved in government, and they know the truth. They see clearly. They see everything 2020 vision, if not better. Of course, when they're in the seat, they have no idea what they're talking about. Of course, they do. I think it's just distraction and diversion. It's a political talking point. They want to claim independence, but, you know, the open secret, they're really not that independent. They know who they're working for. They know what they got to do to get it done. They just have to, you know, come out and tell us, the kids, the sheep, just don't worry about it. Just go over there. Go eat that grass over there. Of course, now go smoke that grass over there, and everything will be fine. You got your television. You got your iPhone. You don't have to worry about it. We have everything under control. And then, of course, you have current Fed Chairman Jerome Powell, as he said, well, we think inflationary pressures are muted. Well, they're muted until they're not. And I've told you guys before, if there is a surprise inflation reading, it's going to be really interesting to see what happens with the Federal Reserve. Are they going to say it's a one-off? We got to wait for more data. We got to be more data dependent. We got to be more patient, wait and see what happens next month, because then they might be too late. I mean, what are the markets going to start pricing in? Another Fed hike? A decrease? Wait and see? I mean, it gets really interesting. They're starting to box themselves in because they're embarking on an experiment that they've never done before to such a degree. So We're going to see things that we've just never seen before because this hasn't been done before on such a large scale. So for me to sit here to tell you exactly what and when it's going to happen, I cannot do that, and I'm never going to pretend that I can. But I can tell you the likelihood of things that are going to happen given similar outcomes and just some basic economics. This will not end well. There's too much debt. Inflation, there's no way in hell it's 2%. You know it's not 2%. But there's going to be a time when it becomes so obvious that the government statisticians just can't keep it down anymore. They just can't. It's just too much of an insult to everybody who are paying attention. And those numbers are going to be what they're going to be. The reality is always going to be the reality. You're either going to go shopping and you're either going to buy more goods or you're going to buy less goods. So whatever these government statistics are, of course, I'm going to keep you updated on them. I'm going to look at them to sort of see if they're starting to flash warning signals or if everything's A-okay. And I'm going to tell you. Right now I obviously have a bearish bias to these markets, but I think that it's warranted given the fact that only 10 years ago, a crisis that was caused by debt, we are now in a situation that has even more debt, and there's nowhere to run to. So we are at the long end here of one of the longest economic expansions in U.S. history, and I think if we hit June without technically entering a recession, it will be the longest. And the stock markets just keep going up, 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 and away, no matter what the news, or if they go down, it's not to any great degree. Again, we'll see if these are technical reasons, if we're running out of steam for those reasons, or if there's fundamental reasons that are starting to trickle in. I'm telling you, the only thing that's going to move this market up from this point is going to be one hell of a catalyst that would surely be for a fantastic, remarkable, and historical deal. Thanks for joining me, ladies and gentlemen. I will most definitely be continuing this conversation because there is much, much more to come. It amazes me how these people obviously know what they're talking about once they are no longer in position to actually do something about it. And ain't that a shame? Isn't that a crime? Please like, share, subscribe, get the word out, leave your comments. I would love to hear from you. I will catch you next time. This is the Capital News. I am Alex Coraitis. Godspeed.